America functioned without banks until 1863. What did they erase? When it's said that America functioned without banks until 1863, the first thing we need to do is separate myth from reality. The United States had banks long before that. The Bank of North America was created in 1781. The first Bank of the United States emerged in 1791. The second bank appeared in 1816. Therefore, it is not true that banks did not exist. What existed was a different level of dependency. Before 1863, the financial system was fragmented, decentralized, and regional. Most day-to-day transactions did not involve formal bank financing. Communities operated with local credit, informal agreements, bartering, and private notes issued by state banks. And here's an important point. This wasn't necessarily better. It was different. At the beginning of the 19th century, thousands of types of banknotes circulated. It is estimated that more than 7,000 different varieties were in use. A dollar from one state could be worth less in another. Counterfeiting was common. There was real instability. In 1863, in the midst of the Civil War, President Abraham Lincoln signed the National Banking Act. The law created a standardized national banking system. National banks began issuing currency backed by federal government bonds. To issue money, they needed to buy government debt. This model had two main objectives: to finance the war and to stabilize the monetary system. In 1865, a 10% tax was imposed on state notes, virtually eliminating their circulation. This forced the transition to the national system. Now comes the central question of the video. Was this change merely a technical necessity of the war, or did it mark a structural transformation of the American economy? Before this consolidation, many sectors operated with locally organized systems. Guilds like the Carpenters Company of Philadelphia standardized prices, quality, and professional training. It wasn't an anarchic system. It was internally regulated. These guilds controlled entry into the profession, required formal apprenticeship, and enforced technical standards. The model did not rely on consistent bank credit. Reputation and reciprocity were fundamental. But there were also limitations. Guilds restricted competition and could protect local monopolies. America functioned without banks until 1863. What did they erase? When someone claims that America functioned without banks until 1863, the first reaction is usually skepticism. After all, the United States already had banks since the late 18th century. The Bank of North America was founded in 1781. The first Bank of the United States emerged in 1791. The second bank was established in 1816. Therefore, it is not correct to claim that banks did not exist. The real issue is not existence, but the level of dependence. Before 1863, the American financial system was fragmented and decentralized. State banks operated independently. They issued their own banknotes. These banknotes circulated as money but did not have uniform value. A dollar issued by a bank in New York might be worth less if used in Pennsylvania. The value depended on confidence in the issuing bank. This system is known as the free banking era, which lasted approximately from 1837 to 1863. During this period, more than 7,000 different types of banknotes circulated throughout the country. Counterfeiting was a constant problem.
Merchants needed to consult manuals called banknote reporters to determine if a note was legitimate and what its real value was. Despite this, much of everyday economic life did not depend exclusively on banks. Local communities functioned with informal credit. Farmers sold on credit. Artisans received part of their payment in goods. Small businesses operated based on reputation and trust. Furthermore, there were guilds and professional associations that standardized practices and prices within certain trades. An important example is the Carpenters' Company of Philadelphia, founded in 1724. This organization was not just a group of carpenters. Its members acted as complete builders, combining functions that today we would separate between architect, engineer, and contractor. These guilds used internal pricing systems called unit pricing. Each stage of construction had a standardized value. This value was not determined by momentary supply and demand, but by calculations based on accumulated experience. Designated members evaluated projects to ensure that prices were fair to both the client and the professional. This model reduced uncertainty and avoided excessive disputes. It didn't eliminate conflict, but it created clear rules. However, while this local system functioned on a limited scale, the country was growing rapidly. Territorial expansion, industrialization, and population growth demanded greater economic integration. The Civil War accelerated this transformation. In 1863, President Abraham Lincoln signed the National Banking Act. The main motivation behind the law was to finance the Union's war effort. The government needed to sell government bonds to raise funds. The new national banking system solved two problems at once. It created demand for government bonds and standardized the currency. The process was straightforward. National banks needed to buy treasury bonds to obtain authorization to issue national banknotes. These banknotes had a standardized design and were accepted throughout the country. This brought uniformity to the monetary system. In 1865, Congress imposed a 10% tax on notes issued by state banks. This tax virtually eliminated their circulation. Thus, the issuance of currency became concentrated in national banks. That was the turning point. From that point on, the American monetary system became directly linked to the federal public debt. To expand the money supply, it was necessary to expand the purchase of government bonds.
This was not a conspiracy theory. It was an explicit mechanism described in the legislation itself. At the same time, other laws were shaping the economic environment. In 1862, the Homestead Act offered 160 acres of public land to citizens willing to occupy it and develop it. The initial fee was low, but the real cost of transforming that land into a productive farm was high. Tools, seeds, animals, housing construction. Historical estimates suggest that the total cost could range between $1,000 and $2,500, a significant sum at the time. Many failed to meet the requirements and lost their claims. Much of the land ended up concentrated in the hands of investors, railroad companies, and large landowners. The emerging pattern is one of an economy that increasingly demands capital. And organized capital tends to require structured financial institutions. At the end of the 19th century, with industrialization advancing, so-called company towns also emerged. These cities were controlled by companies, especially in the mining and heavy manufacturing sectors. Workers were often paid in script, an internal currency that could only be used in stores belonging to the company itself.
This model created dependency. Because the prices in the company's stores had no external competition, they could be high. Workers accumulated debt and had difficulty leaving. The famous Pullman strike of 1894 demonstrated the tensions of this system. After wage cuts without a proportional reduction in the rents charged by the company, workers went on strike. The conflict spread to several states and required federal intervention. These events show that the economic transition was neither simple nor linear. Before 1863, banks existed but operated in a fragmented system. After 1863, the system became progressively centralized. The currency became backed by federal bonds. Monetary issuance became more uniform. Dependence on institutional credit increased. This brought clear benefits: greater monetary stability, easier interstate trade, and the ability to finance on a large scale. It also brought consequences: financial concentration, greater integration between the banking system and the government, and a growing dependence on debt as an engine of economic expansion. The creation of the Federal Reserve in 1913 further deepened this centralization, establishing a central bank responsible for regulating the money supply and acting as a lender of last resort. Therefore, the question, "What did they erase?" needs to be answered carefully. The existence of banks was not erased because they already existed. What was transformed was the structure of economic trust. Local models based on reputation and community agreements lost ground to a standardized national system, anchored in public debt and centralized financial institutions. This transformation accompanied industrialization, urbanization, and population growth. The previous system was not perfect. It had monetary instability, counterfeiting, and regional inequalities. The subsequent system is not perfect either. It has financial crises, debt cycles, and a concentration of economic power. The central point is that 1863 marked a structural transition in how money was created, distributed, and regulated in the United States. Understanding this transition helps to understand why almost all economic activity today involves financial intermediation. Buying a house, starting a business, studying, expanding production. It all depends on structured credit. America didn't function without banks before 1863. It functioned with less centralized banks and a greater influence on local economic relations. After 1863, the axis of the system shifted. And when the axis shifts, everything else reorganizes itself around it. If you'd like to delve deeper into the evolution of this model up to the creation of the Federal Reserve and understand how the banking crises of the late 19th century influenced that decision, that could be the topic of the next video. But the essential point is clear. 1863 did not mark the birth of banks in America. It marked the beginning of the definitive centralization of the national banking system. And this centralization shaped the country we know today.